it's the opposite of got a hunch, bet a hunch. And the thing is, we're going to assume in this audience, I know we have a lot of issuers here, I know we have a lot of people in the business, I'm going to assume that this really is the elite audience that we talked about in there. And there's so much emotion out there. There's so many people that really do. The philosopher Hume said that reason was the handmaid of the emotions. Like you think you're making a rational decision. You think you've thought this through. You've got great arguments. But in reality, you're just justifying something that you want to do for other reasons. And so I think that's the distinguishing characteristic here. The successful speculator is not a wild gambler. It's not an emotional, impulsive person. It's someone who has trained that muscle, that discipline of having a plan, following it, not freaking out because the market fluctuates or whatever, and discipline eventually pays.
Now, your handle on Twitter is due diligence guy. So when you are researching a company and a project or projects, how much due diligence do you actually do? And what's your definition of due diligence?
Yeah, how do is diligence. Well, there's two different ways we can go on this. I'm reminded of the FTX fiasco and major funds. How much due diligence do you do when you allocate billions of dollars? They must have spent millions of dollars on the due diligence, and they're still taken in with a guy in a t-shirt and a lot of hair. So sorry, but that's the facts, right? So in a way, we don't want to kid ourselves that, our due diligence is the best. And we'll never be fooled. We'll never make mistakes. We know everything. There's limits to how much anybody can do. And in the mining space, we've all seen majors or mergers. They bought a project from some junior or another, and then they go in, and it turns out, you know what, the deposit isn't really there. Or it's not the way we modeled it. Right? So you've got to have some humility. You have to understand that your due diligence is never going to be complete 100%. You're never going to know everything. But the 80-20 rule applies here. If you even just bother looking and trying to question what's on the PowerPoint and verifying any of the facts, you're already ahead of 80% of the herd. Just bothering to try to check anything puts you there. And then if you actually apply boot leather to the ground, if you actually go and look, then you can do that 80-20 split again. You're ahead of 96% of the crowd at that point. And that alone can make you deliver better than average odds. It sounds simple, and in a way it is. Just bother trying. Put the effort in. You want to make millions of dollars. This is a get-rich-quick scheme. Do the work, and you'll come out ahead than most people.
Let's talk about gold. You say that your impression of it, your attitude and approach to it has been evolving, has been changing, in part because of what you perceive to be a changing correlation to inflation, and also the fact that gold stocks, maybe not the last week or two, but have been acting a little bit more robustly. Can you elaborate on that?
Yeah, well, as we speak, it's a funny day to talk about gold. Are we at that moment where we got to within kissing distance of 3,000 and now gold's over? I don't know. I don't think anybody knows. Nobody knows in this room. So where do we go with this? But the evolution of thinking is this. Gold had a great year last year. And we got a hockey stick. Yay. To have another great year like that, to have another hockey stick twice in a row, that's a pretty big ask. That's hard. And so it's not that I turned bearish on gold. My outlook was bullish on gold, but to expect gains like we saw in 24, again in 25, it just seemed the odds were not going to be my favor there. But, except for this week, the market action and what we've seen in the geopolitical front, the tariff front, all these things going around, the typical headwinds for gold have not knocked gold back this year. We're having a good year, unlike, say, Bitcoin. We're having a good year in gold, and that's despite the things that in the past would have set it back. It's really perversely ironic that whenever we've gotten a higher inflation rate over the last few years, that's been bad for gold. Well, in the last couple of months, that has turned on its head. There has been a shift in the market. So as a market participant and observer, I can't ignore that. It's hard for me to say gold is $3,000 an ounce. Oh yeah, it's got another hockey stick this year. But the market market data is telling me that there's a huge bid under gold. There's been far more robust appetite, even at these levels, than I expected. Now, is that about to change? Is it changing as we sit here having lunch? I don't know the answer to that. My feeling for this year has been somewhat binary. With getting near that big round number of 3,000 could either spark the next big leg up because of all the headlines and excitement and flavor of the day, or just the central bank's buying and they don't care what the price is, or it could trigger a lot of profit taking. It could trigger the opposite. There could be a substantial correction in the gold space just because a lot of people made a lot of money and nobody goes to taking profits. We might be at the point right now as we talk, we'll know in the future which way it is. So I'm not sure I've answered your question there.
No, I think you did. I want to keep it going with gold as well. When you're researching a gold company and again, a single project or multiple projects and assets, what are the attributes that the company absolutely has to show you? And what are the red flags where you immediately dismiss the company and you just don't want to pursue it anymore?
Well, Doug Casey taught me the 7 and then 8, I believe there are now 9 P's of resource stock evaluation. And the first P was always people. It's not literally a little black book, but I have accumulated a list over the years of the people who have lied to me or materially, let's say, misled investors. And that's an absolute non-starter for me. And no, I don't publish that list. I don't want to get sued, but it exists. And it's just, I don't care what the rocks are. It could be the greatest project, but if it's people who have screwed shareholders before, sorry, that's a technical term, I'm just not doing it. As for the rest of the P's, the project specifics, basically I start with my macro, actually. If I'm bullish on gold this year, I'm also bullish on copper, I'm bullish on uranium. And if you're going to be bullish on gold and copper, you can't not be bullish on silver. So, this is what I'm interested in. So, who are the companies that are doing something of interest here? And there's different levels. Personally, I have a barbell strategy. My version of the barbell strategy is to have a few of the majors, the lower risk end of the pool that are going to do well if I'm right about the commodity. And then the other is some juniors that give me that hockey stick potential. This doesn't leave a lot of room in the middle for the mid-tiers. Mid-tiers that may be takeover assets I think are interesting. And I understand that there's people who have different levels of risk tolerance. Personally, I'm very reluctant to bet on early stage exploration, greenfields exploration. The risks, even with the best in the business, are just so high. I might go there with a prospect generator that puts other people's money at risk. Other people just love that. They want 100% of the upside in their greenfields. They just want to swing for the bleachers. And I'm aware that I have clients at all these different levels. But basically, it's which commodities do I want to look in, which companies have the right stuff at whichever level, whichever basket the client is interested in, or myself, I'm my own first client. And then the due diligence process of all 7 or 8 or 9 P's.
Well, you've said that 2025, one of the themes will be volatility, in large part because of what's happening in Washington. Also, while gold was your call last year, copper was your call this year. So can you expand on that?
Yeah, we can broaden it too. So I just talked about how hockey stick after hockey stick was a big ask for gold. And looking at the metals that I like, maybe now uranium is corrected enough that every surgeon there, we're down more than 40% in uranium, so a rebound there would be a pretty big move. But at the time we made the call, gold and silver and uranium were not all that cheap, whereas copper was still relatively low. I saw more hockey stick potential in copper, and that was why I made that my call for 2025. But I didn't rush to buy because Trump had won. We could see the writing on the wall. We didn't know what would happen. If not an agent of chaos, he's certainly an agent of less predictable change, let's say. So it was foreseeable that there would be a lot of boat rocking coming out of Washington, D.C. And as a famous Doug Caseyism, make volatility your friend. So rather than rush out and buy copper, I thought, well, let's watch for that volatility. Let's see if that creates better entry points. And one specific strategy for this would be to sell puts. if you sell a put on something that you want to own anyway, but you're not worried about it, having a serious company-threatening event if there was a tariff or not a tariff or anti-tariff or whatever, something you want to own anyway, you sell some puts, you make money on selling the puts, and if the volatility happens, you get put. Now you own something that you wanted at a good price. And if it doesn't happen, you still get paid for selling the puts. So this is the kind of strategy I mean when I say make volatility your friend. And unfortunately for me, I don't get everything right. So copper was my top pick for 2025, and copper's already had a great year. But that's before the volatility kicked in. And I gotta say, we've now seen Trump is focused on copper with his new thing. But to me, it's kind of idiotic that the copper price went up on that basis. He hasn't done anything yet. We don't even know if he's going to do the tariffs. He's studying it. So, what do I know? Copper's up, but not for the reasons I said, at least not yet. I'm still thinking, we're not done with this. It's all the art of the deal. There is no tariff trend right now that you can reliably, reasonably predict any commodity price changes, because it could all be yanked tomorrow. Right? I mean, even with Xi, last time, Trump 1.0, he made a deal with Xi. So, even China, and not to mention those people in the Great White North, there could be a deal. It is, I think, extremely dangerous to say, here's what's going to happen, here's what the tariffs are going to do to aluminum or steel or copper, therefore I buy this, that, or the other. I think the most reliable thing to say is, we don't know what's going to happen, therefore, what are the strategies I can pursue to make volatility my friend? That includes copper.
So we don't know what's going to happen, so does that mean, can we extrapolate that we don't know in terms of Trump? Lost my train of thought there, sorry.
Let me jump in. We don't know.
Will his policies be inflationary?
That's where I was going. Okay, so we don't know exactly what the policies will be, but we do know that the agenda is inflation. So we're not operating in a complete vacuum. And this was kind of the beauty of the situation last year, is it didn't matter who won the election in the U.S. Either party was going to pursue an inflationary agenda. I know there are a lot of people who are excited about Doge and Elon waiting in with Milei's chainsaw and cut spending. And maybe it won't be as inflationary as we think. Well, I'm sorry, and I'm on the anarchist end of the libertarian spectrum. I love lower taxes. I love cutting government spending. I'm all in favor of wielding that chainsaw as mightily as possible. But as Jefferson said, experience has shown that it's a very risky proposition to imagine that anybody's going to seriously reduce the beast of Washington. Firing, if they fired every single employee in the entire federal government, which you couldn't do, but if you did do that, it's something like 15%. And it doesn't touch all, the entitlements, it doesn't touch Medicare, Medicaid, the interest expense alone, $1 trillion plus and growing. So I'm very skeptical that even with the best of intentions that the administration is going to be able to cut spending, and meanwhile we've got all kinds of goodies and we're promising tax cuts, that this is an inflationary agenda. I'd love to be proven wrong, but until then, it's an inflationary agenda, and I think this is bullish for commodities as a group. I do think, however, that you need to be selective. I picked copper, not just all industrial minerals, because I see copper facing supply constraints. I don't think that's going to be a controversial statement in this group. That's not the case with nickel right now, where we've got Indonesian company just pumping that stuff out like there's no tomorrow. It's not the case with lithium. So it's not all commodities will do equally well. The inflationary agenda, I think, is broadly actionable, but you still need to pick your commodities.
You mentioned one of your mentors, Doug Casey, before, and one of his favorite phrases that's really stuck with you, volatility is your friend. Why do you like that phrase so much, and are you already seeing some opportunities based on the volatility?
Well, I think that almost is self-explanatory. Just look at what's unrolling around us. Let's say I had decided that Trump was going to be tough on Putin, and therefore uranium is going to go through the roof because we're going to cut off all that uranium. And I had imagining that I thought I knew what was going to happen. Or let's say the opposite. Let's say I thought Trump was going to end the war in Ukraine in 24 hours like he promised. And I bet big that, this would produce, a flood of all kinds of, let's say oil would go up as the war ended or something like that. Well, I would have lost the money betting on that sure thing also, right? So when you have a chaotic agent of change, it's just, no matter what he says, no matter what the priorities are, you can't count on any of these things as sure, reliable investment trends. The one thing we do know is that it's going to cause chaos and change. Therefore, make volatility your friend. Selling the puts is just one strategy. The other thing is just simply have a shopping list. If you want to own the blue chips, A, B, C, D, think of a stink bin that you'd be happy to have filled and keep that in your pocket. And if it happens, it happens. If you have the means, and in this room, I imagine there's quite a few, if you've got a checkbook, and there's a company out there, a junior, that's doing great work, like they actually have a discovery of merit, and they're advancing it, they're drilling it, and they need money, then participating in a private placement could be another great way to make volatility your friend. So you don't have to know the future, or you don't have to know specifically which way things are going to go. If you generally think about, okay, let's have my own optionality. Never mind, Rick Rule's optionality in the field. I want my own optionality. Here's my strategies. What I'll do if this happens or that happens. This is when I pounce.
You mentioned Rick Rule a couple of times, another one of her mentors, and one of the things that he likes to say, and he said this to us in a recent Red Cloud interview, is that he really loves hated sectors and hated stocks. And would you say, you mentioned uranium, do you think it's hated right now? Is it at that point?
Yes and no. Actually, he likes to say, hate, I love hate. Hate has made me so much money. And we are getting that. There's sort of a barometer of when I post on X about uranium. If nothing happens, the sentiment is good. If I post just the price, I just post the spot price, and I get a bunch of angry people. Oh, uranium, fraud, I lost so much money, blah, blah, blah. But, then I know that it's an interesting time to buy. And we're there. Right now, I'm getting almost as much pushback on uranium as I did in 22, when it hadn't done anything for 9 months and people were panicking. But the problem with this is, right now, here's another one of these things. We don't know what's going to happen. Agent of chaos. Trump is talking denuclearization. He's talking decommissioning nuclear weapons. Now, I don't think this is going to happen. I think even if they announce a deal, I don't believe for a moment that the Russians will actually disarm, and the Chinese are building it up. They're not going to participate in that. So I don't believe that there's going to be any real or material impact of any kind of new megatons to megawatts project that might be announced. But if it is announced, or even if just the treaty is announced, I think the market will react very strongly. So this will be one of those things where reality will be one thing, and the buzz, the market reaction could be quite another. So if Trump hadn't started talking about this, is something that's literally changed in the last week or two. If Trump hadn't started talking about this, I would be out there, pounding the table. This is a buying opportunity. Make hate your friend. This is the time, right? It's the correction is way overdone. The long-term contract price is way above spot now. I don't know where the bottom is, but I see an opportunity right now. But this new thing, and I've got people angry at me for even saying this. Oh, our uranium stocks are suffering enough. You don't need to add more negativity. But it's not my job to tell you what you want to hear. It's not my job to be a cheerleader. I'm trying to help. And if this scare comes to pass, again, not the reality, if this scare comes to pass, our already hated uranium stocks, the spot itself, could go considerably lower. I see that as a potential another source of making volatility, my friend. So if I had no uranium now at all in my portfolio, I might go ahead and buy it because it is hated. But I'm long uranium. I don't have to back up the truck for more right now. And if there's a buying opportunity right around the corner from a big scale coming out of the White House, I'd love to take that with both hands.
Let's switch to silver, which is in this low 30s range for quite a while now. Seems pretty comfortable there. the gold to silver ratio is still quite elevated, around 90 last time I took a look. So what is that relationship telling you right now?
Not a lot. I know that a lot of silver bulls get very angry at me for saying this, but I have never found any predictive value whatsoever in the gold silver ratio. And the fact that it's extreme, I'm sorry, that's just the way it is. The fact that it's extreme doesn't mean it can't get more extreme. There have been occasions where it swings, like a big move, a change that has momentum in that ratio. That does tell me something. There's something changing in the market. But just the fact that the number's big or small or whatever, that doesn't tell me anything. And I'll add some more rotten tomatoes here for the silver bulls, and I'll go further and say that it is a mistake, in my view, to believe and to bet big money, bet the farm on that ratio going back to its historical average. Pick your average, even if it's the more recent one of 50 to 60 to 1 against. That is not a sure thing that it will ever go back to, let alone the historical long-term average of 19 to 1 or whatever it is from Roman days. The market doesn't have to do what you want it to do. The use case for silver is changing. And I understand that silver is money, and I'm not being metaphorical. Silver is money. I know that it's the word for money in many languages. I still stack silver. I've got more physical silver than I have gold. But the use case has changed. Basel III includes gold, not silver. When there's the good news is that the industrial side of silver gives it an upside that gold doesn't have. So if you think I'm hating on silver here, I'm not. I actually see silver on the other side of the kerfuffle here as more of a win-win. Gold is the same saving. Gold is money. Gold is cash, in my view. Gold is savings. But silver gives me the opportunity of having that monetary mantle on its shoulders. Plus, once the inflation kicks in again, once we have a reflationary boom, if we make friends with China, all the solar panels and all the applications, the industrial side of silver gives it an extra tailwind that gold doesn't have. So I'm not anti-silver at all. But the reality is, you look at silver and copper and gold, and there are times when, for a year, silver will correlate more with copper than with gold. You can ignore that, you can hate me, you can throw tomatoes at me, but that's a mathematical fact that you can go and verify. So, the good news is I'm bullish on copper and gold this year, therefore I'm very comfortably bullish on silver. But I think that's important to be, reality was part of the subject of this panel here. So I have to say the reality is that silver, it's increasingly driven by its industrial side, and you ignore that at your own peril.
Back to process questions. When you're deciding on an investment, how much do you lean on data, a lot of it your own data, and how much do you rely on intangibles such as your experience, past experience, or a management team, or even gut instinct?
I guess it depends on what you mean by data. I think my list of people who have gravely disappointed me is highly material data, even if it's hard to quantify. It's binary, 0 or 1. I guess on the macro level, that's where, my gut, if you will, my wolf whiskers twitching, as I like to tell my reader. LOBO means wolf in Spanish. So instead of the other hand, I always say on the other pole. So there are times where it's kind of, I get the feeling, like right now, my wolf whiskers are twitching about gold. The rollover that we're seeing right now seems significant. And by the way, maybe it's not coincidental that Bitcoin is rolling over at the same time. For what it's worth, I'm not making a prediction here. I'm just saying that right now it feels like something is happening in the market space. But I try to be extremely data-driven. We have a team now, and we review all the publicly available data on the companies we look at. We have a list, including insider buying, selling, the capital structure, where the warrants at, are any coming to the market soon? Is there a wall of cheap paper about to hit this stock? The members of the board of directors, in my experience with management, that's a little more subjective, I grant. But have they done this before? That's another rulism. I don't want somebody who's got success in the oil patch looking for Canadian shield gold or the reverse, right? And that is something anybody can do. By the way, I have a team, I have a network in the industry, I've got my years of experience. But anybody can look at CDAR, anybody can look at EDGAR, anybody can look at Canadian Insider. There are tools out there that all of us have available to us, and I strongly believe that so many retail investors still follow them. Got a hunch, bet a bunch. Oh, that sounded like a good story. I'm in. But all you have to do is bother to look, and you will outperform the investment herd.
So when you've done your due diligence on a company and you're making that decision whether to invest or not, can you take us through your decision-making process? Is there a checklist, or how do you approach it?
Yeah, so it would depend on the company type where we're at. There is a checklist. It's more like survival, a game of survival. If you survive this round, or scientific process perhaps, if you survive this proof, I'm looking for the fatal flaws. I'm looking for the Achilles heel. My time is valuable. There's thousands and thousands of companies out there. So the goal is to find some reason to disqualify it as quickly as possible. Triage, basically. The shit list of people who lied to me, that's an easy and obvious one. If it's not the right commodity, it's an easy and obvious one. Political risk, politics is one of those P's. Unlike my friend Rick Rule, I'm highly averse to political risk. If there's a country that's just been through a coup or two in the last couple of years, that's just a no-go for me. Because you can wake up to a headline in the morning that takes your capital to zero like that. There's no time to get out. So the things that disqualify quickly are the ones I look at first. The deeper we go, if it's a producer, by the way, they've got to make money. That seems like obvious and a brain, but there's so many people that tell themselves it's the reason is the handmaiden of the emotions, right? They're attached to this company that it keeps losing money. A very prominent silver company or two I can think of who fall in this basket. Like, if you can't consistently deliver to the bottom line as a producer, then I'm just not doing it. If you're a developer, you have all the permits in hand, you have money in hand, is this really going forward, or are you still just trying? Are you pretending? And by the way, just because a company has developer in the name, doesn't mean they're developing squad. I want to see the whole checklist ticked off, shovels ready to hit dirt, or in process. To me, a real developer is mind-blowing, not a wannabe. If it's exploration, is there a thesis? It's a vein, it's disseminated, whatever, and we're drilling it, and they keep hitting results. Is there predictability there? All of these things. The details would be infinite, but the process would be triage, and then deeper due diligence until I've asked every question I can think of. I've looked under every rock I can think of. I compare notes. I still compare notes with Doug or Rick, and I have a team too. If we can't find anything wrong with this, and I really like it, and I see the upside in it, then it's a candidate for my money.
And then once you're invested, your average hold period is more than 2 years, which is almost 2 years more than some people can stand. So what's your rationale there, and how do you find that kind of patience?
Well, I have to say, it's not by design. It's not like that is my target range. But most stories just take at least usually more than a year. Every once in a while you have some kind of near-term binary outcome. Like if the speculation is, I really like this exploration target, and they got the money, they're going to test it this year, and it's kind of all or nothing. They hit or they don't. Well, that has a very short-term fuse. I don't make a lot of bets like that. I'm usually not in on the discovery hole. I'm usually in after that. And actually, usually like 2 or 3 press releases into a discovery. Because that first part of the sine curve, you all know what that is, right? Anybody not know the sine curve? Okay, so that first part of the sine curve, that's not just one hole. That's going from that discovery hole to basically the first resource estimate. That is a process that can easily take a year or years. And if they have high predictability, we're talking about, it's a vein and they keep hitting. Well, those press releases over the course of that year or two are going to add value to that story. So there's a lot of money to be made with much less risk jumping in on what I call success in progress. They've got the discovery and they're defining it. that success and progress, maybe it doesn't have the same bagger if I got in before the discovery hole, but nobody knows who's going to make that discovery hole. Not Rick, not Doug, certainly not me. So I have substantial gains to make with much, much less risk. Another of my favorite strategies is the pre-production sweet spot. And it turns out that the average time it takes to build the type of mine that I've invested, copper majors, that's a different thing. But a junior going from explorer, developer to actual producer, the average length of time for that is about 2 years. And that is hands down my favorite type of speculation. There's a free report on the website if you haven't read it, the pre-production sweet spot report. It turns out that the average gain from a construction decision to first pour is on the order of a double. It turns out that 95% of the companies that set out to build their first mine succeed in doing that. It turns out that 70% of all the cases in the study, almost all that there are, I think, over the last 3 decades, have a positive return of some kind or another. The value added from pouring money into holes in the ground as you drill to taking money out of one big hole in the ground as you mine is so big that the average gain is still positive even in a bear market for companies that succeed in doing that. So this is one of my favorite strategies. It takes time.
One more question here, and then we'll get to some Q&A. We've got about 5 minutes left for that. Mic's on either side of the room. You know the routine. Put up your hand, and we'll get a mic to you. Just lastly here, you mentioned Rick Rule several times. We've interviewed him several times. I've had the pleasure of doing that going way back 10, 12 years or so. One of the things he says is that some of his biggest winners have also had at least 50% drawdowns over that time, and he's just held on. So how much of a drawdown are you willing to ensure if the fundamentals of a given investment hasn't had a change?
Yeah, I've experienced that as well. An example would be Skeena. I'm not giving a stock pick. I'm not telling anybody to buy this stock, but I bought into this early, actually before they picked up SK. I bought it on the basis of SNP. And to their credit, boots on the ground, due diligence is my thing. I went and looked at it, and we flew over SK on our way back from looking at SNP. And they didn't tell me a word. They didn't whisper a word. And like a week later, they did the deal on SK with Barrick. So kudos to management for no wink, wink, nudge, nudge, actually doing things right on that. But anyway, I was deeply underwater on that for years. Apparently there was a disgruntled, if not founder, like early stakeholder, some geologist or somebody who had named their shares and just kept selling every time it was news. And I averaged down and averaged down again. And I got to tell you, I was nervous. People say that your best trades are usually the one that you end up hurling into the garbage can and place that trade order. So I averaged down several times, and I don't remember how deep underwater I was. But they kept adding value with the drill results. Like there was nothing wrong. Every time the story got better, and it got cheaper. So I want more. I did take profits before that went up. It was a 10-bagger from trough to peak for me, but I took profits. So I think I only got like 5 times my money or something. But I'm telling you that I've seen this. It's real. It really does happen. If you're somebody like Rick, though, and you're managing funds and you've got people who are there with you for the years, it's easier to ride that out. If you're a newsletter writer, my joke is that evil scum of the earth newsletter writer, that's how I introduce myself on mining trips. A lot of your audience isn't going to be that patient. It comes back to your time frame too. So I do try to avoid the downturns. This is actually, I just talked with my friend Doug Casey, and it's a difference between Rick and Doug, and they all talk about how you have to understand speculation is risky. You're going to lose money on most of your bets, but the big wins, to use Rick's word, will amortize the losses. Your average will come out ahead better than money back. I have found that very few of my clients, my readers, can take those kind of drawdowns and can handle losing money on most of the bets. They just don't want to do that. So I actually try to win money most of the time. And my current public track record, you can see, it is exactly 2/3. I have won exactly on 2/3 of my completed trades so far that you mentioned, the 41%. So, we'll see. I think I have fewer 10-baggers for that. I'm not swinging for the bleachers the way I did before KC Research. But my average gain is like twice what it was in KC Research, and I think I have, my readers at least are more comfortable because at least, most of the time you don't lose money.
All right, questions? What do we have? Put your hand up. There's one back here.
Great. I just got a question about sort of junior producers. So I used to work at a company in Goldstorm, Ghana, and basically it was, about a 1,200, ASIC producer, right? And then it, go from 1,400 down to 1,100, then 1,000. And I remember Kevin McLean loved their stock because it was had a high beta. But it sounds like you wouldn't invest in something like that. But it seems like the high beta return, like, is it going to go bankrupt? Is it going to do really well? Is interesting to some others, but it sounds like you wouldn't invest.
Yeah, I wouldn't, but there's a thesis out there, and mathematically this is true. Like the marginal producer thesis. If you're, at Nico and you're making $1,000 an ounce and gold goes up $10, it's de minimis. If you're a struggling junior and you're making $1 an ounce and gold goes up $10, you're 10x your margin on that. So that is mathematically true. But you have to ask yourself, why is this a marginal producer? And this is another free report on the website, by the way, if you look for marginal producer. And there's a huge amount of risk here. Like, why is the company crappy, basically? What did they do wrong? Is it just the deposit? If it's the deposit, if it's just a low margin deposit, there's nothing they can do to fix that. It is what it is. If it's management, maybe a new sheriff can fix that. But I would need to see the proof in the pudding. The number of times I've been picked, oh yeah, this is a great thing. They just mined it wrong. They didn't realize the dip was this way or whatever. And I have been hurt so many times on that. I just don't go there. I would never, personally, buy a stock on the basis of the new sheriff in town is going to fix this. I will buy it if the new sheriff does fix it and there's still growth in town. Who's next? Back here.
Are a core factor in de-equitization, and is the cultivator possibly coming to an end, and then your trade comes to an end almost because there's just no capital allocated to it?
No. I think I understand your question, but at the end of the day, we are in a business that deals with a physical reality. The world, our civilization above the Stone Age, needs metals and mining. Somebody's going to make money bringing this to market one way or the other. And if it isn't through the equity trades that I specialized in, if it's some other way in the future, maybe that'll happen. I'm more worried about what AI does to our businesses. I think that we are getting to a point where AI will probably do better than most of my competitors. I don't think AI has boots yet that they can apply boot leather with. But at some point, if you combine the AI and the robots and actual fact checking on the ground, I think even my job might be threatened. For now, I'm comfortable. But this is a real thing. When you can ask an AI bot to interpret the latest press releases of a junior explorer or producer, and granted, yes, there's hallucinations out there. I just asked the Google one, I forget what it was, what time it was in Colombia, and it completely hallucinated. It told me it was like 6 hours off, and it's not out. You're actually here at this time zone at the same time zone. So there's still reliability issues there, but they're working on this. And so the good news for anybody who's a consumer, anybody who wants help digesting, I mean, think about it. I have a whole team. I've got all these years of experience, and it's all about digesting this enormous amount of information in this resource sector and trying to bring the nuggets to the attention of my clients. Isn't that what AI does? So at some point, I'll need to brush up on my dishwashing skills or something. We'll see, but it is something that I'm watching, and I'm actively working with my own team on how can we use these tools? How can we use them better than the average bear? We'll see.
Thank you so much, LOBO, for being with us. Thank you, everyone. I appreciate it.
Thank you.